So this is the second session. Okay, and just before the end of the first session, I was talking about um, there are three layers of this research um, that are interesting to most countries. Okay, so I was talking about the three layers being one, demographics. And so that's about, the what's the fertility rate, what are the proportion of people that are over the age of 80 years old, and so there's going to be a lot of what are commonly referred to as entitlements or entitlement programs that where you kind of promise to take care of your elderly people in the population. And of course, you need to have workers. And that leads into the second layer, which is what we call migration macroeconomics. Okay. And so that's just not just about the decision about where people choose to live or to work. Okay. Because in some countries, they have what is referred to as foreign workers. Okay. That aren't citizens of the country, but basically come there under work permits to work and to fill in um, basically the jobs where there are shortages. Maybe you've got a really old population like Japan, and you need to have workers to help take care of them, and so on. So that demographics is the kind of it's the foundation about economies and so on. And then, of course, migration economics or macroeconomics, which is not just about the decision to live or to work in a particular place, but what are all the macroeconomic implications of that in terms of developing a housing stock that they live in. And so there are some stock flow dimensions that lead into why we have developed DSG economics or models that go well beyond infinite horizon representative agent kind of models that you find in central banks. And then finally, and lastly, um, the last layer, which is technology. And so with artificial intelligence, with robots, so there are going to be robots in all different types of activity, including they're already being used in Japan for helping old people take care of really old people. And so there's some heavy lifting there. Robots as companions. We're thinking about older people, but you can always have robots to help take care of children and so on. So we're entering this new age where artificial intelligence will be used as a labor saving device, and of course um, how countries choose to interact and exploit that technology will be really important in terms of helping the world and so on. So I was just at the point where we were talking about models with endogenous money creation. And so maybe Maria can bring back the screen to the point where we were talking about those particular things. Now, we're going to, in this first session, we're going to be talking about models with endogenous money creation and financial stability and those sorts of things because uh, they're so important in terms of how we understand all economies because virtually every economy today has a modern financial system. And in modern financial systems, it's really important to understand what commercial banks do. And so we're right at the point in the lecture where we were saying that the way that this is typically represented in standard textbooks, and we referred to a textbook of a private school in Diligent, for example, where they where in the very first page they talk about the role of banks as collecting deposits and lending them out, and that's not the way that it works in the real world. The way it works in the real world is that people walk into banks and ask for loans for things like houses, which we call mortgages. And the banks, some commercial banks specialize, have business models that sell mortgages, but they might sell car loans. They might sell other types of interest-bearing assets and so on that obviously will be on the bank's balance sheets. So this is really important because when these loans are granted, the moment that they're granted, there's a matching bookkeeping entry on the liability side of the commercial bank balance sheet where purchasing power is given to the person that got the loan that allows that person to go in and basically purchase the house. And what happens after that, anybody knows. It all depends what the person who gets the proceeds of that sale of that house does. Do they go out and make another loan to build another house, or do they actually pay off some of their debt? And so the process of creating money through making loans, which we call endogenous money creation, there can also be destruction. So what does this mean? It means that we have to really watch the commercial banks. We have to really watch agents in the financial system. This is what really watching them what should have been like. So in 2008, August, we have these green little balloons on the screen. And what those balloons represent are the magnitude of new loans or new mortgages in the United Kingdom. And so we have these plotted at values of the loan to value ratio that you can see is 65 or up to 65% of the loan over the value of the house. Okay, so if the house was $100,000, and if you took out a loan of $65,000, okay, then your loan to value ratio would be 65%, and so you'd be in that little balloon on the left hand side, and so you'd pay a spread. So your mortgage rate minus, so this is from the perspective of the bank, because what the bank is doing is it's making money off the difference between the interest rate that it's getting on the asset side of its balance sheet or this mortgage, okay, and what the cost of its liabilities are. So if those were deposits, okay, it would be the deposit rate. In this case, it's just really easy for us to measure the bank rate, which is the rate at which banks lend each other money very short term. Okay, so that's a very convenient rate to choose to calculate what the spread or what the difference between the mortgage rate of these new loans is. Very important for me to say new loans to differentiate between new and the stock of existing loans. So we see before the global financial crisis, which started on September 15th, 2008, with the bankruptcy of Lehman Brothers. Okay. And so we see in the United Kingdom that there was a lot of new loans, mortgage loans being made that had a very low spread. In other words, the interest rate on those mortgage loans was not very high relative to the bank rate. And so I just want you to be impressed by how big those balloons are above 85 and 95% loan to value ratios. So it's like financial markets had underpriced the risk in these risky loans that have really high loan to value ratios. So the global financial crisis hits, and this is in the chart, just taking another snapshot of what that looked like a year later in August of 2009. So obviously what happened is what happens in every financial crisis when there's been an excessive credit expansion and asset price bubble where risk has been underpriced. The very first thing is obviously banks stop making these risky loans, and so you see the magnitude of the balloon at the 95 shrinks drastically. At the 85, it shrinks quite a bit. But you can see that basically the 75 shrunk a little bit, and of course they're quite prepared to make loans at the 65 plus the less risky loans. So what happens is the interest rate charged them increased, and the banks obviously tried to repair the riskiness of their capital positions by not making these loans anymore. If we advance 1 year to 2009 or 10, so we go 1 year forward, assuming that Maria has awakened from her nap. Uh, um, so if we advance 1 year further, you can see that the market now is coming back. 2009 was a really bad time because we were in the heart of the global financial crisis and so on. As the economy started to heal itself, we can see that there was more credit. So the dark blue is getting bigger, but and the very risky segment of the market, the 95 plus, had come back a bit, but they were still charging a much higher spread on those risky loans and so on. And we advance 1 more year, and you basically see now a bit more recovery going into 2011. So the market again gets bigger, the economy is healing, but there's still an upward sloping trajectory, which I think is something that we would want to see in an economy where there wasn't this massive underpricing of risk. Um, so okay, so that's these wonderful data from the United Kingdom. We like those data because you can see both the quantities as well as the interest rates on those mortgage products. So this is just looking at what I was referring to earlier, where we look at the commercial bank balance sheet. And so you think about this as the consolidated balance sheet of all the commercial banks. And so on the asset side, they might have loans, or they might have purchased treasuries, what we call securities, and so on. This is really important now because obviously when banks make loans or mortgages like they did during COVID, in one case, for example, the 30-year jumbo mortgage rate was below 3%, got all the way down to 2.8%. Well, if you make a loan for 30 years fixed at 2.8%, and if what happened is that the mortgage rate doubled, then you're going to take a massive capital loss on those kinds of low interest rate loans or securities, government securities that you might have purchased at really low interest rates. So the asset side of the balance sheet right now is risky because it has a lot of really low interest rate loans on it. Okay, now how risky? Jerome Powell recently in a speech on CBS has indicated that it's not uh, a problem that is as large as the global financial crisis. Uh, I would uh, I would agree with that uh, if one was only looking at the underpricing of interest rate risk and its direct impact on the commercial bank balance sheet. I think that's right, but what I do not share um, is the idea that there are not very large macroeconomic risks related to the increase in the size of the household balance sheet. So there's been a $43 trillion increase in in the value of assets. These are both financial assets since the first quarter of 2020. So obviously, with the lockdowns in the first quarter of 2020, we observed a decline in equity prices, which made perfect sense. But what didn't make any sense was a highly expansionary monetary and fiscal policy that took real interest rates down into negative territory and effectively drove asset prices to Mars. And I'm referring specifically to equity prices. So the S&P, for example, has risen by over I think 116%, according to the recent numbers since the trough in 2020. And how is that possible? Because obviously we produced less output in nominal terms cumulatively because of COVID. And so how the heck why would asset prices rise? And the answer is because the discounting through the lower real interest rate. Now, of course, we've had some adjustments to the real interest rate, but if those adjustments were to be much higher, then the the kind of effects that Jerome Powell is talking about by focusing just on the valuation effects in the commercial bank balance sheet, that might very well be smaller than what the problems were on the bank balance sheet related to the global financial crisis. Um, but um, but that is ignoring an asset price bubble that is much larger than the global financial crisis, humongous compared to what people thought the asset price bubble might be before the global financial crisis. Uh, House prices have also gone up by about 50%. Now, what's worrisome about this? What's worrisome is that if consumption continues to do what consumption does, which is to be based on real disposable income and these measures of financial and non-financial assets, financial assets being equities and bonds and cash effectively, and non-financial assets being property prices. So if those things stay high, then why Jerome Powell and everybody else on the planet should worry is that if that continues to support consumption, well, housing is a very important part of consumption. And and with that type of consumption, one always sees that houses are financed by credit. And and so the asset price bubble that we're seeing in the US right now, and that's everywhere. If it's in the US household sector, it's absolutely everywhere. With that, if that were to rotate, which it almost certainly will, if asset prices stay high, into increase enough flow demand for consumption and housing services, that means that we will be observing higher leverage over the next several years in that kind of scenario, and that could be extremely dangerous because then you would have the dual combination of an excessive credit expansion and asset price bubble. So we certainly got the asset price bubble now, but we don't have the excessive credit expansion when one refers to it relative to nominal GDP or nominal disposable income. But I should only say that you have to be careful when you're measuring like the stock of credit and you're dividing by nominal GDP. You have to realize that that nominal GDP, that level of nominal GDP is also supported by high asset prices. So it could be very well that you could have in a bad situation that the denominators in our credit, the GDP ratios could actually fall. So I'd be very careful about that. But anyway, um, back to the screen. Um, so the old way of thinking about banks, which unfortunately is still in too many textbooks, is kind of thinking of them as loanable funds where these bankers collect deposits and lend them out. That's a very dangerous way of thinking about the world. The way the world works is endogenous money creation, where banks see that there are opportunities of making loans to people, and if those loans are viewed as being profitable and not too risky, they make them. And so this is a much better way of thinking about the financial system, because if one thinks about it that way, then the potential for asset price bubbles and excessive credit expansions is much better. Now we have loanable funds, um, financial institutions in modern financial systems. In many countries, we could call those things mutual funds, or so there are some banks that or financial institutions that collect deposits and and invest on behalf of their clients. So uh, pension or life insurance companies and stuff like that have regulations about collecting people's money and then lending it out on their behalf to make money off those funds so that they can then pay back or provide a flow of income to the people that have invested in those assets and so on. But when we think of commercial banks and modern financial systems, it's endogenous money creation. That's the way to think about it. You need to think about it that way when you look at the world every day, because if you don't think about it, you'll get everything backwards. Very nice videos by Shelva, who's the head of the Monetary Policy and Research Department at the National Bank of Georgia. Check our YouTube channel and he'll explain all this stuff from the position of a practitioner in a central bank thinking about monetary policy and financial stability issues. Okay, so that's our endogenous money creation story from the perspective of the bank balance sheet. Now, let's look at what implications that has for the global economy. So the first thing is that in this world, and this is why I was saying that you have to think about this as being relevant every day. So in a model with loanable funds, from the perspective of the global economy, which is a closed economy, it's really, really hard in a model with loanable funds to think about why there would be such a strong correlation between investment and consumption. So, so what financial cycles come from in a loanable funds model is basically thrift. Um, it's because saving is equal to investment. So how do you explain why you could have a big investment cycle? In other words, a big overinvestment in things like the housing sector and so on, like for the global financial crisis, or like in China today. And the way that you would argue it is that it's because of high saving, because saving has to be equal to investment. And so if there's anything like a technological revolution that comes along in the loanable funds model, okay, where the banks are collecting these deposits, somebody has to make a sacrifice to save to allow the economy to invest, because saving has to be equal to investment. So that's the logic. Now, with a modern financial system, one is not um, subjected to that hard constraint, because if people go into the bank and they have an idea, um, maybe artificial intelligence, maybe if we want to go back to electricity, they have this idea, they walk into the bank and the bank gives them a loan. Well, that means that investment and consumption together, when there's a environment where people are expecting good times in the future, consumption investment can rise together, because they can consumers and business can both get loans to finance those expenditures and so on. And so that's the most obvious reason why in the data that investment and consumption on a world level is very highly correlated. Okay, so that's the story. Why in a nutshell, why you need to have models with endogenous money creation, because they're just much easier to understand what happens in the world on a global level, and so on. Okay, so if we can now take a look at what this means in terms of a virtuous credit cycle. So this would be an example where you have artificial intelligence, okay, um, and so you got these guys that have an idea of taking a machine and making things more productive, and so they get a loan from these banks to basically hire workers and to buy some technology. So let's suppose that it's artificial intelligence or whatever, or a robot, like in the picture. Well, what does that mean? Well, incomes in the economy increase because the workers are getting these incomes, as well as the people that sold the machinery to these guys. And that, of course, is going to allow consumption and investment to increase. And of course, what will happen next? The economy will be growing. There will be improved economic prospects, and then the banks will make more loans to people, and it will carry on and will be described after the fact as being virtuous, in the sense that our modern financial system allowed us to get access to financial markets. You might say the futures market, so that people could consume more and invest more today, just based on the confidence that bankers and everybody else had that it was a good idea. Okay, so that's a virtuous credit cycle. Of course, the artificial intelligence, and this isn't an exaggeration, could effectively be a complete scam, like like machine learning as applied to economic problems is a complete scam, in the sense that it's doing absolutely nothing to further economic and financial literacy and so on. And so, in a vicious credit cycle, if you can get me back to the previous slide, um, so what happens is the bank makes a loan, and of course, um, uh, it realizes that this is a scam, or it has been a scam. So now they cut off the loans to the firms and the banks. So this is what's going on in China right now. Okay, and that of course results in declining incomes, lower consumption and investment, and worse economic prospects. And of course, the banks now go into a tightening phase because they realize that their bank balance sheets have a bunch of really bad assets on them, like the developers' balance sheets have in China right now. Okay, so this is a vicious credit cycle. So just as the economy can experience a virtuous credit cycle where the economy is booming and consumption investment strong, you can have everything going. Okay, now how do we make this work? Uh, on the next slide, we have what is referred to as a financing constraint. Okay, now this sort of sounds a little bit like a cash in advance constraint, but it's not. Um, this is a financing constraint that's related very much to endogenous money creation. Okay, so we're going to think in the economy that there are three uses of money. And so on the left-hand side of the equation, this financing constraint, we're going to have nominal consumption expenditures. Okay. And so those we're going to assume that basically we need some money or some purchasing power to pay for that. The next thing that the economy needs money for is the purchasing power that's necessary to finance new investment goods. Okay, so we're going to think of that as PI times big I. Okay, so that would be like a new house. So the investment that's required to finance a new house, okay, would be included in the PI times I, but also any physical capital, uh, any new physical capital, and so on. And then the third term, which is actually quite interesting, because it's kind of connected to asset price bubbles and so on. We have the price of capital. So this could also be the price of houses times capital. So K is real capital, and so that would be think of it as the quantity of the stock of housing, or the quantity of the stock of physical capital. So that'd be all your businesses and so on. And so if you go into an asset price bubble, so PK goes up, um, the price of houses or the prices of equities and so on. And so that will mean that you need some more money to finance, if there's turnover in those assets. Okay, now, okay, so that's what you need money for on the left hand side of the equation, and then of course on the right hand side, deposits. And so deposits would be used in most cases to finance normal consumption expenditures and so on. And then, of course, when you deal with much bigger ticket items, like houses, for example, you're not going to be able to finance those out of your regular demand deposits. You're going to have to go to the bank and get a new loan. Okay. And so on the next slide, we describe that graphically by looking at at the uh, the equations. So the purchase of a new or existing physical capital would be the PI times I, which is the new capital, or what we call investment goods. And then, of course, your PK times K would be the purchase of existing physical capital at whatever the new price is, PT. And so you could think of it as purchasing a house, which we have in the picture. And of course, that then resulting in a derived demand curve for loans, okay, which is, so how do we get the purchasing power to buy the house when we can't finance it out of our deposits? We have to get a loan from a bank. Okay, so that's the money creation process, and having this financing constraint in the model is going to be critical for talking about those kinds of issues. Okay, so that's the example of money creation. Now we can move on to, um, well, this is just saying the same thing. So now we can go on to, money destruction, which we already talked about. Everything just works in reverse. Okay, so once that money is created, once the purchase of the house happens and somebody gets the deposit to pay for the house, well, there could be money destruction immediately, because if you purchase the house from somebody that had too much debt, then they might actually uh, go into the bank and reduce their loans, and at the same time deposits in the consolidated banking system. So it's possible that just that one action of going in and getting the loan could be completely reversed if it ended up if that money ended up in the hands of somebody that that had loans that were too high. Okay, so now of course that's not typically what happens. The money stays in the economy and leverage continues to grow over time up until some point where, like during the global financial crisis, or like during what's going on in China right now, people realize that they have too much debt, and when that happens, uh, paying off those loans results in lower purchasing power in the economy and so on. So this is really, really important to understand that modern financial systems typically give credit to households and businesses, as much credit as they need. Um, and sometimes they underprice the riskiness of doing that. I think it's definitely been underpriced in the case of advanced economies right now. I see the risks as being much, much larger than what Jerome Powell has factored into his calculations about about the vulnerabilities on the commercial bank balance sheet, because of giving these low interest rate loans to people. And the reason is that I think he's missing the general macroeconomic uncertainty of this humongous asset price bubble that is associated to underpricing interest rate risk. Okay, so we just move on to the next item on the agenda. Okay, so what is map mod? And so technically, this is going to be a model with endogenous credit default risk. And so the borrowers are going to use their bank loans to finance consumption and investment expenditures. So that's just as we had in the financing constraint. So that's not anything different. The second point is that they're going to borrow against the value of their assets. So in other words, think of it as the value of their houses. Okay, but it could also be their physical capital. It could be their equities, or in this case, it could be their house. And these individual defaults are going to be a function of ex post asset prices. So in some states of the world where asset prices are really low, okay, and they've effectively lost all their equity in their house. Okay, so imagine you bought a house for 100,000 and you had a 95% loan to value ratio. So you put 5% down. And so you had a loan of $95,000. The house was 100,000. What happens if the value of the house goes from 100,000 down to something below 95,000? So now the household that's bought that house is now has negative equity in the house. Okay, so we're going to assume that some of those people might want to walk away from that house or to declare bankruptcy. So that's what we mean by individual defaults are a function of ex post asset prices. So these individual defaults are going to be driven by common aggregate factors and idiosyncratic factors. And so I'm not concerned uh, about those idiosyncratic factors. I'm concerned about the common aggregate factor that has generated a humongous asset price bubble in the U.S. household balance sheet and every market that I can think of in the planet, since the U.S. household balance sheet is probably one of the least risky balance sheets on the planet. So I'm going to be worried about these common aggregate factors and how they can vary over time. It's going to be critical as a part of the buildup of the model to assume that this risk cannot be diversified away. That it's really easy to defend that now because the problem is so big that it would be impossible for anybody in the economy to offer an insurance contract that guards against really bad things happening in the world right now. And the reason is that nobody has enough assets in the world to deal with that problem. It can be so humongous. But I'll just say that as a purely logical implication of the model, that it's got to be impossible for that risk to not be easily diversifiable, and it has to reside on the bank's balance sheets and so on. So that's more of a intellectual thing, but it does have a very important real world counterpart in the sense that that's probably the case now that the asset price bubble has got so big that it's impossible for anybody to deal with it. So let's carry on. So in MapMod, the banks are going to hold these loan books, so not trading books. Again, the emphasis is not on things like liquidity risk. The ability that banks have to expand their balance sheet is going to be limited by capital regulation. So we're going to have this minimum capital adequacy ratio, and it's going to be applicable to this ex post realized value of assets. Okay, so I already told you that, but also their liabilities and their equity. And so the banks are going to make two types of decisions. They're going to be assessing these borrowers as they walk into the bank. And what does that mean? It means they're assessing their assets and trying to verify them. to see if they actually truly are assets and how much they're worth. Um, and they're going to offer these individual lending supply curves. Okay, and those curves are going to look uh, like the curves that I showed you with the little bubbles earlier, as we're going to see. So they're going to do that. So they're going to assess the individual borrowers. Okay, and then second, they're also going to look at the entire size of their loan portfolio. Okay, and they're going to ask, is that portfolio is it profitable? And in bad states of the world, um, if if I had too large of a loan portfolio, would I expose the bank to unnecessary risks? You know, because I had a big loan portfolio and maybe something bad was happening that changed the the value and and how risky that loan portfolio was. So two decisions: individual lending supply curves and what is the optimal size of the loan portfolio and so on. Now, what's the rest of the model? The rest of the model is going to be very standard. Okay. And again, this was done in on top of infinite horizon representative agent kind of setup. So we can advance to the next slide, please. Um, okay, keep on. Uh, okay, so go back. Sorry. Okay, so I messed up. Okay, so we're just going to talk about these two fundamental nonlinearities in the model. Okay, the one that refers to the individual lending supply curve, which is going to be very much like a financial accelerator, like Bernanke, Gertler, and Gilchrist. Um, and so this lending spread, okay, so these are like the bubbles that I was talking about earlier. They're going to be increasing in the loan to value ratio. And so now, of course, this is going to be based on how risky the economy is. Uh, and so this nonlinearity in this curve is going to be given by the distribution of total individual risk. Now, remember, the individual risk had two types of things in it. It had this aggregate risk and idiosyncratic risk, the risk dealing with the specific people that they're lending money to. And and so we're going to see this curve on the next slide. Okay. So this is the left-hand side, and so the curve is basically a convex function that says that the lending spread, okay, or in this model we can also think of it as non-price lending conditions. In other words, we can think of it as both quantities being affected, much like in the bubbles that I was explaining earlier. So non-price lending conditions would be like reducing the availability of lending to the riskier part of the distribution in the economy. Okay, so in the real world, obviously, the lending spread is highly correlated with the availability of credit to the riskiest part of the economy. So you see, it's not a flat line like what we showed you before the global financial crisis. It's upward sloping as the loan to value ratio rises, and like you would want in an economy that is regulated appropriately. At some point, maybe when the loan to value ratio reaches 100, you'd expect that the spreads associated with that would be really, really high if it was priced in properly. Now, amusingly, there's some wonderful data from Ireland when we presented this paper in Ireland at the Central Bank of Ireland. Uh, they actually showed us some data where the loan to value ratio gets over 100, and so the bubble got so big in Ireland, in Dublin in particular, that banks were prepared to make loans to people uh, where the value of the loan was actually bigger than the value of the house. So now it only got up to 110% and so on. But this point at which the curve gets really, really steep is is uh, is interesting. Once before the crisis, it can be very, 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 very flat. Okay, and of course, when there's underpricing of risk, um, this can give rise to the seeds of a financial crisis. So if you just um, go up a slide again, and we can talk about the curve on the right, up a bit, not down. But so if you can go up a bit, and we can talk about the the optimal loan portfolio. Okay. If we could talk about the optimal loan portfolio, I don't know where you're going up so much. It was only up one slide. Um, so we talk about the optimal loan portfolio. Okay. Um, so stop, go up one slide. So the optimal loan portfolio. Okay. Lending spreads will be decreasing in the banking capital adequacy ratio. And so again, this nonlinearity is going to be given by the distribution of aggregate risk on the loan book. So what does that mean? So we go down to the slide with the curve. It means that the banks are not going to want to get close to this 8% minimum capital adequacy ratio. Okay, now why is that? The reason is that as the banks get closer to this minimum capital adequacy ratio, what's going to happen is the regulators will visit the bank, much like they visited Citibank during the global financial crisis, and they will start, demanding that the bank start selling a lot of its risky assets. Now, the problem is that once you're in that crisis, the value of those assets are going to be the prices are going to be very distressed, and so the banks are not going to want to sell assets at what they consider in some cases to be really good assets because that was their business model, right? Getting those assets, and now all of a sudden, um, they're not going to want to sell those assets, and so this is why there's an incentive for banks to stay away from, keep their loan portfolio away from this minimum capital adequacy ratio because of the punishment that they'll face. Now, what happens if there's an underpricing of risk? Because remember the steepness and position of these two curves. So if there's an underpricing of risk, then the curves are going to shift. And so if we could please shift the curves. So in this case, the one on the left becomes more elongated. Okay. And this is like what we were trying to portray with the size of the bubbles. In other words, there was banks were giving loans to people, new mortgage loans, at rates um, that weren't rising with the loan to value ratio. Okay, so we can think of that as an outward shift of the Bernanke, Gertler, Gilchrist curve. And of course, on the right hand side, we can think of that financial accelerator as being banks not as worried about this minimum capital adequacy ratio. So getting closer and closer to it. And then, of course, obviously, not only the curves can shift, but you can move along the curves, and both are are potentially dangerous at unleashing a potential uh, financial crisis where we get these really bad interactions between financial conditions in the economy and the real economy and so on. So uh, if we can just go down from here to some of the scenarios, I will then go through those scenarios and talk about that. Okay, so this work plays off of a lot of empirical work where people have tried to use effectively estimates of fundamentals, growth fundamentals, to drive business cycles. Okay, but all that research was done in infinite horizon representative agent kinds of models. In models with endogenous money creation, expectations of future fundamentals like productivity growth are going to be really important. Okay, like even more important and even more sensible, and so on in models with endogenous money creation. So, as I said right at the very beginning of the lecture, um, we're going to want to have a model where you can have both good and bad credit expansions. And so the first good credit expansion that we're going to talk about is one where there's higher productivity growth. Okay. Now, this is actually really relevant because before the global financial crisis in the United States, potential growth was revised up by over a percentage point. Okay. So the period in the early 2000s to 2007, there was about a 1 percentage point increase in potential growth that basically was mainly productivity growth. And so that's why we're actually starting off with this as being one of the fundamental drivers for that financial cycle. Now, if you wanted to dig, the model's really not about the United States. It's just about a hypothetical economy where we can illustrate how this works in many different kinds of economies, including economies like the United States. But what I will try to do is when I go through the results, is talk about those things um, that will generally be applicable to virtually all economies, and those things that are specific in the results to the particular setup of the model, because it's going to be an open economy, infinite horizon representative agent model. Okay, so uh, if you go back up to the slide, uh, um, so the four things that we're going to look at first are good and bad credit expansion. Okay, so we're going to talk about what that is. Okay, then we're going to look at another type of bad credit expansion that's based on underpricing of risk. And then again, because of the non-linearities, because non-linearities are so important for getting everything right, really bad credit expansion, like what happened for the global financial crisis, and like what's happening in China today, and any financial crisis, is always a combination of people's expectations about fundamentals like productivity growth being too optimistic, as well as an underpricing of risk. Um, uh, that basically, where the financial system has clearly, just been behaving myopically and underpriced risk. So to show the importance of the nonlinearity, we'll talk about a really bad credit expansion. where you get a big global financial crisis like the types we observed in 2009 and 2010. And so to show the nonlinearity, we'll combine the two types of bad credit expansions. Then to complete the analysis, we will also look at some other um, uh, experiments on the next slide. And these other experiments are looking at things like countercyclical macroprudential policies. So how effective would they be at dealing with uh, the seeds of financial crises? And again, this is very much related to the whole issue about trade-offs. What are the implications of a permanently higher capital adequacy ratio? So, what would be the long-run effects or the steady state effects of capital requirements? And of course, what if you were going to impose higher capital requirements on the economy? What would be the dynamic effect? So we have a bunch of experiments where um, if you told people in advance that you were going to raise the capital adequacy ratio, how would the economy adjust relative to a situation where you totally surprise them? And then lastly, what are the effects of linearizing macro models that that have these financial accelerators that are fundamentally nonlinear? Okay, so let's go through the first set of experiments, which are quite interesting. Again, all the experiments have been set up so that they're graphically really easy to understand what the intuition is and what the logic is for them. We're going to assume that everybody, households and firms and policymakers and everybody on the planet is expecting higher productivity growth over the next decade. And it's going to turn out that expectations are correct. Of course, this should emphasize that in the real world, people don't know these things and they're always incorrect. Their forecasts are always incorrect. And so I just want to emphasize that in this case, everybody knows exactly what's going on and they're correct. Okay, so what happens in a modern financial system? Um, what happens in a modern financial system? It'll be on the next slide, please. Um, is just to look at the characters in the slides on the first column. So we're going to have to get used to this structure. We have output and consumption and investment. It's an open economy setup where the shock to productivity is in the traded goods sector. So you're going to have Balassa Samuelson going on here and so on. So the first column has GDP, consumption, and investment. And you'll notice that there's a cycle. Okay, so it has to be true. And you can also see we're plotting years. It's actually a quarterly model, but we're plotting them as years to make the results easy to interpret and so on. And you see that GDP approximately goes up by 10% after 10 years. Okay, so the economy is not in a steady state yet, but it would be kind of close to what its steady state would be because in the very long run, GDP goes up by 10%. Now you see there's a cycle. And so why is consumption higher? Well, people see the higher productivity, they see the good times coming in the future, and so they want to consume that today and so on. The firms in the economy, they realize that productivity is not only higher today, but it's going to be higher in the future. They want to invest. Okay, so that's why in a model where you have endogenous money creation, where they can both go to the bank and get access to credit, credit's going to expand and so on. And so I'm going to jump right to the last column, which has the bank or the financial system variables in it. And so on the top right-hand side column on the right, we have real credit. Okay, and you can see that real credit is growing uh, quite rapidly. And you can see that the banks, so we plot the lending spread. Okay, so again, this would be, if you wanted to think about it as the simple stylized little model that we had before, it'd be the lending spread or what the banks make in terms of the rates of return on their assets. In this case, their mortgages versus the interest rate on their liabilities. Okay, so we were thinking about it as the bank rate before. Okay, and see that spread goes down here by 30 basis points. So in the story, the banks see this higher productivity in the future. They see high growth, and so they start making loans to people at really good terms because they believe that the loans are not, really risky. Now, in the very last column on the very last row, we have the post-default capital adequacy ratio. And, one of the reasons why they're prepared to take this risk is that in the experiment, even though the minimum capital adequacy ratio is 8, you can see the post-default capital adequacy ratio is 11.5. And why is that? Well, because as I indicated, banks want to hold a buffer between the capital that they actually have and what would be the minimum capital adequacy ratio. And they do that because the world is uncertain and so on. But it means that if situations arise where they feel that they can make profitable loans that aren't risky, which again is the assumption in the simulation, they'll make those loans, and they'll make those loans at very favorable conditions to the financial or to the households and so on. And that's a characteristic of financial cycles, that the seeds of them are associated with high credit, high consumption, high investment, and very low spreads on lending conditions. Now, you can also see if you move over from the bottom uh, uh, row, you move to the left, you'll see the real value of the capital stock. And so you can also see the increase in asset prices when people realize that productivity growth is higher. Obviously, since it takes time to develop the higher capital stock, real capital stock, the price of capital will rise. So you see there's a little bit of a jump in the real value of capital. That's what's going on there. You look at the physical capital on the second row on the third column, you'd see it obviously responds slowly over time in response to higher investment. Above that, you'll see the net foreign asset to GDP ratio. I told you it's an open economy, so they're actually borrowing from the rest of the world, or you could think of it as running their net foreign assets down. The second row, I would not focus too much on this, or not second row, the second column, wage inflation, CPI inflation, and the policy rate. That thing will be pretty specific to the open economy setup. Okay, so I'm going to basically just ignore that column because that will depend on if the productivity is in the traded goods sector. It'll depend on a host of assumptions that are related to monetary policy. So I'm going to leave that one out of my story. Okay, so that's the modern financial system where everything's working perfectly because basically everybody gets access to their future productivity, and 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 modern financial system allows them to get to the new steady state as quickly as possible. Okay, and so that would be the if I was an academic, I would say that would be the optimal plan. Uh, if you were absolutely sure that we were dealing with a really super good idea that was going to pay off like electricity. Now, what about artificial intelligence and robots? Maybe, probably that it will raise productivity. Will it be as big as electricity? Uh, Not at this point. Um, Artificial intelligence is more best thought of as something that's going to be a labor saving technology. So there are certain things that we can do that's going to save us a lot of labor. Could come a day. Uh, don't rule this out that artificial intelligence could kind of, ramp up um, to the point where it's starting to discover things. Okay, but it's not at that point right now. It's more of a we've got a really big tractor that can help us plow the fields better. That's the way to think about artificial intelligence. But it could come a day uh, where it could we could have some incredible discovery. I don't rule that out. But anyway, okay. So this is your the wonderful case where you have a modern financial system. Something really good happens. Everybody understands the fundamentals higher, and then boom, uh, you get to the new steady state faster with the modern financial system under endogenous money creation. Okay, so the next set of slides is just breaking that into three parts of basically what I've already gone through, but let's review them. So again, the first thing, what happens? We get this higher productivity for 10 years. It results in higher levels of consumption, investment, wages, employment, real incomes. And it's all because banks make loans to facilitate the adjustment to the new steady state. Okay, so these are the basic stylized facts that we would see in the real world. Next set of stylized facts are what is going on in the financial system. To asset prices are rising. Um, Lending spreads are being so they're offering credit at very very cheap rates, and of course the quantity of credit or real credit growth is quite high, and of course banks will be prepared to uh, reduce their capital because basically the profitability and because they believe the loans are good loans. Okay, now what happens with everything else? Um, so again, this is the part that depends on the nature of the economy. In this particular case, it's an open economy. Um, Effectively, aggregate supply in the economy is rising more than aggregate demand, and as a result, inflation is falling. But in addition to that, um, there's also some interesting things going on with the exchange rate. So the real exchange rate has to be appreciating because of Belassus Salmson. And so there's a little bit of a monetary policy exchange rate story here. But again, if the economy is booming, everybody knows it, that aggregate supply is going to be high today and in the future, then the central bank could be, I guess, more comfortable cutting interest rates or having interest rates low in this kind of environment. And of course, it wouldn't be seeing inflation, headline inflation, which includes things like imported goods, would actually be becoming cheaper over time. Now, of course, this is dependent on the assumptions for monetary policy. There's absolutely nothing hard coded uh, in this model that could not be coded in a different way. And so that's why I say don't get lost in this column on monetary policy, since it could play differently under different assumptions about monetary policy as well as the specific type of shock that we're dealing with. Okay, so that's the really good credit expansion. Um, now let's talk about a bad credit expansion. And so uh, in the bad credit expansion, the only thing that really differentiates the bad one from the good is that after 3 years, the growth that has been achieved up until the 3 years, that's in the bag. Okay, so that level increase in productivity, which is about 3%, that's that's good. Okay, that is maintained forever. But then the productivity growth in the remaining 7 years, that's gone. Okay, so there's a realization in the simulation that the path that you were on, where you were expecting high productivity growth for a long time, that's not right. It didn't end up being as as persistent as what you initially thought it was going to be. Okay, now if one were to tell a story, a real world kind of analog behind this story, if you look at that period up until 2008, where productivity growth was really, really high, you have to realize that that's GDP, chain weighted GDP. And part of that increase in real income that would be measured in chain weighted GDP was the Chinese being prepared to lend money to the US to finance their current account uh, deficit, as well at a real exchange rate that was really, really low. Okay, so and so that real income calculation in chain weighted GDP, that increase in the growth rate, is partly because they could buy stuff from the Chinese really cheap. Okay, so you might say that those good times um, were extrapolated into the future, and of course resulted in higher leverage and higher asset prices. So, but that's what we're trying to kind of uh, connect it to, is to see whether or not we can get a financial cycle as big as what types of financial cycles we've observed in places like the US during the global financial crisis. So that's what we're trying to do here, is see whether or not we can build a model really easily that's based on endogenous money creation, where we can get magnitudes that are of the scale that we actually observed in real world economies like the United States. And so here we go. So if we just consider that people were extrapolating, and in this particular example, they've only been extrapolating for 3 years. Okay. Um, and and in fact, the extrapolation up to this point made sense, but then they realized in the third year that their expectations were way too optimistic. So what happens? So what's really cool here to a modeler, or one of the things at school, is that everything's smooth up until this point, but when there's a revision in expectations, and your economy has excessive leverage, the banks have excessive leverage because it made all these loans. Uh, um, the household sector has excessive leverage because they were trying to build up their stock of housing, for example. And so now there's uh, there's this financial crisis uh, where you get these very vicious nonlinear interactions between real and financial variables. So you can see just on the chart, you can see the real economy GDP is crashing, and you can see the real value of capital is crashing because asset prices are are crashing. So that would be thinking about equity prices. Now, when you look at the magnitude of them, you go, well, it's not very big, and that has some implications. We will also consider other types of uh, bubbles simply because of the mispricing of assets that that when we look at the real world, they can be off the fundamentals for long periods of time. But this would be an example where just a simple misperception of output uh, could result in a fairly large revision in asset prices. Or if you thought about the blue line as being a bubble, a bubble just because people were too optimistic. And if people learned that it was a bubble, then you'd observe obviously a crash in asset price bubbles because they'd be expecting less output in the future. Okay, so that's the first thing. Um, and so we've got something that looks like it's about minus 4% at if we look on asset prices, and so it goes from about +3 down to about -4, so it goes down by about 7%. Well, that's significant, uh, but that's not a stock market crash. A stock market correction is usually 10% and so on. So just to put things in perspective. Now OPEC does collapse by 4%, okay, or 4%. Okay, so that's quite a bit. Okay, so let's carry on. Look at the rest. So uh, what happens? Well, consumption, which we normally think of as being pretty smooth, consumption and investment both crash, and that's also a characteristic of financial crises that smooth variables like consumption lose some of their smoothness. You look at the financial system of the banks, once they've realized that they've taken on a risky position, that the risk on their balance sheet, their loans, has been big, they realize that they're going to have non-performing loans. And of course, what do? They stop making those loans, those types of risky loans, and they charge a much higher spread. And so you see the spread on these lending rates now jump up to 120 basis points, or what's 1.2 percentage point deviations in the chart, and so on. Okay, so just when the economy needs easier financial conditions, the banks are tightening, and that's of course why consumption and investment are tanking, and so on. So what happens everywhere else um, to the other key variables? Um, so you have to look at the full package of graphs. I guess we don't have it. No, we don't have it. Okay, um, so I'm almost done here, and I just want to kind of knock this one out, okay? Because um, uh, Maria is promised to make a much more professional version of this presentation for the students by um, COB on Monday. Okay, so I just want to finish this off to get it out there. Okay, now um, I already said that in the presentation up to this point that asset prices um, don't change by enough. Like 7% is nothing to write home about. Um, I should have also said that in the global financial crisis, there was clearly underpricing of risk. So I want you to all go back and listen to your movies, your documentaries on the global financial crisis. And in all those movies, uh, there were these things called ninja loans or loans made to people that had no income, no job, or no assets. And and so these were well, obviously there was a lack of basic financial supervision and and a lot of very bad behavior by virtually everybody in the story. Um, but basically, the rating agencies turned a blind eye to it because they were making money off of it. The people that were actually selling the products uh, to the people that were um, taking out the mortgages, they were making up stuff, um, things that weren't true. So there were loans being made to people that had literally no income, no job, or no assets, and so on. And so we're going to call these under ninja loans or an underpricing of risk. Now, what's going to happen in this scenario is that there's going to be this underpricing of risk is going to build up on the bank's portfolios, and this is kind of really neat. Uh, is that from the point of view of the aggregate behavior of the banking system and the real economy data, it would be very difficult to detect a problem using standard macro aggregate. So we like that. We like that story because that's uh, going to mean that it would be difficult for people to detect on the basis of macro data. Okay. Now, what's going to happen, like in the case of the productivity growth shock or the excessively optimistic assumptions about productivity, we're also going to have this assumption that after 3 years, banks' assessment of risk becomes accurate again. Okay, so like for 3 years, they underprice risk, and then after 3 years, they're going to realize that they have underpriced risk, and then of course a very similar process is going to happen with the revision in growth fundamentals. So the economy is going to go through this deleveraging process with this vicious nonlinear feedback loop between real and financial variables. Okay, so let's just take a look at it. Um, Qualitatively, what's impressive here is that the same um, qualitative results that we saw earlier. Uh, so if you can just give me the next slide, please. So when we look at what the results are, so again, with the gray, this is the first 3 years, okay, and what do we observe qualitatively? Well, we observe that GDP, consumption, and investment are rising. On the right-hand side, we observe real credit growth, low lending spreads, and of course, capital being reduced by banks because they're making loans to people. Asset prices are high, They're going into debt with foreigners, building up the physical capital stock. The monetary policy column is a little bit different. So in this case, inflation is higher and they're raising interest rates. Okay, but again, we're not going to talk too much about the monetary policy implications. We're talking more about the more fundamental financial cycle, macro interactions. And so what happens is that after 3 years, when they realize that basically that they've been underpricing risk and that these risks have been building up on its balance sheet, uh, when that happens, it also looks a little discontinuous, okay, in the sense that you see asset prices or the real value of the capital stock falling from 0.5 to about 1. Okay, so you're seeing a little bit more there, but not very much. And that's kind of interesting. It's kind of interesting because what it means is that if there is underpricing of risk, so now I'm talking about digging deep into the model and checking everything and so on. If there is underpricing of risk, okay, and if that's all that's going on, so if nothing else is going on, then if you just look at what the value of assessing specific risk just on the banking sector, which is basically what we're looking at here principally, it would be a small thing. But if and this is very much related to my comment about Jerome Powell, because he's saying now that the problem in the on the bank balance sheets is not as big as it was during the period before the global financial crisis, and I agree with that. But what I would also say is that if that underpricing of risk were connected to a much bigger problem, like uh, like creating a humongous asset price bubble, okay, that the implications of that could be much higher than during the global financial crisis and so on. So I would just be wary that when you're just looking at these effects as little incremental effects, be careful. And you'll see that in the next slide, because in the next slide, what we're going to do now is to look at a really bad credit expansion. And this is really a combination of the two things. This is taking the first bad credit expansion, where it was because of overly optimistic growth fundamentals, and adding to it this underpricing of risk. And what happens is, because of the non-linearities, because of these two financial accelerators, now we get a crisis, which is very interesting, and I think an important insight that policymakers like Jerome Powell should be aware of. So if you just go to the next slide, you'll see that now in the third year, GDP is going from a plus 5 at the peak to a -2. So that's a 6 percentage point swing, which is the kind of magnitude that we'd observed during a global financial crisis. You look at investment, it falls from a plus 15 to a -3, an 18 percentage point swing. So the kinds of numbers, the BAA spread did rise about 300-400 basis points, and So the magnitudes of these models uh, are not out of line with the kind of real world kinds of dynamics that one sees and so on. So, um, what does this mean? It means number one, the students need to have a better understanding of how the world works with a modern financial system. That's what it means. Okay, for the purpose of today. For the purpose of our research, for those students to get to level one, that's pretty well you have all you have to know. You have to learn how to basically build a model with endogenous policy credibility. You have to learn about the monthly projection model, and you have to build, a small open economy version of that linked to the U.S. That's what you have to do for level one. And of course, you need to do current analysis up to Bob Solow standards. But what you need to do for level two is deeper. So what HiCAS is working on now, for example, is models that start off with with this enough heterogeneity that one can take the kinds of models and results that I've been referring to here and extend the model to include kind of more real world considerations for building what I would describe as more serious models for doing macroprudential modeling and so on. But that work is, to a large extent, basically the time that HiCAS and Hamid and I have to spend on it. Now, as we get better developing, I like to call them milk cows. In other words, modeling projects that will be highly valuable to policymaking institutions. That will allow us to free up more time for us to develop these more exotic models where we can actually apply the ideas of nonlinearities and uncertainty for even bigger issues like macroprudential policy analysis, and very much connected to that fiscal policy analysis, which I'm going to take up in the very next lecture after doing some basic review of stock flow relationships in the economy. We'll then jump into the last model in the AMPM2 collection, which is the global integrated monetary fiscal model. And so on that note, and given that it's Friday afternoon and we have to still get ready to have a Zoom session with Hamid Faruqi at 5 o'clock, I think I'll leave it there. Okay, so thank you very much, students. I'm really sorry uh, for lecturing the heck out of that. Did you get anything out of what I was talking about, or did you fall asleep?
Um, no, of course not.
Uh, Boring as hell, but now you're ready for the weekend. Uh, is that what you were? Uh, Leah's not even responding. So, okay. So what time is it there?
Um, it's 4:20.
4:20. Okay. So, okay. Well, this has to be turned into a very professional video, okay, by COB on Monday. You think you can do that?
I will try. Yeah.
You'll try? Okay, good. Okay, well, I'll leave it there. then
Okay.
that's all we can do is try. So let's see what you can do.
Yes. Wants me to change this phone.